Insights for the informed investor.
Herd behavior and rationality in financial markets. Bill Ackman, a famous investor and founder of the hedge fund Pershing Square Capital Management, is known for his clear and well-founded views on investing. In numerous interviews and speeches, he shares some of the key principles that define him as a successful investor. One of the most important principles he repeatedly emphasizes is the need to resist herd behavior. Herd behavior refers to the tendency of individuals to mimic the actions of a larger group, especially in stressful situations. In the financial market, this instinct can lead to irrational decision-making. For example, when markets begin to fall, many investors panic and start selling their assets simply because others are doing the same. This behavior can exacerbate downturns and lead to even greater losses. Ackman explains that in order to succeed in investing, one must resist this natural impulse to follow the crowd. Instead, one should remain calm, rational, and deliberate in their actions. He believes that those who can withstand emotional pressure and make well-thought-out decisions during times of market panic will be more successful in the long term. Ackman's emphasis on maintaining emotional discipline is crucial, as it allows investors to identify opportunities when others are acting out of fear or greed. Ackman often references specific instances where he successfully avoided herd behavior and capitalized on market inefficiencies. For example, during the 2008 financial crisis, while many investors were fleeing the stock market, Ackman remained calm and sought out undervalued companies with strong fundamentals. By not succumbing to the panic that gripped the market, he was able to make investments that yielded significant returns once the market recovered. This approach requires not only a deep understanding of market dynamics, but also a strong emotional fortitude to go against popular sentiment. Price versus value and the influence of Benjamin Graham. A major influence on Ackman's investment approach is Benjamin Graham, the legendary author of the book The Intelligent Investor. Graham is often regarded as the father of value investing, a strategy that focuses on buying securities that are undervalued compared to their intrinsic worth. In his book, Graham explains the fundamental difference between price and value of a security. Price is what you currently pay for it on the stock market, while value is what you actually receive over time in terms of earnings, dividends, and growth. Ackman often emphasizes that successful investing is about understanding this distinction and recognizing when a security's market price is significantly lower than its intrinsic value. Ackman likes to illustrate this concept with a vivid metaphor. The stock market is like a neighbor who offers you a different price for your house every day. However, just because your neighbor is offering a price doesn't mean you need to sell or even consider his offer. Instead, you should wait for the day when the offer is exceptionally high, or when it aligns with your understanding of the house's true worth. This metaphor underlines the importance of patience in investing. Impulsive reactions to market fluctuations can lead to poor investment decisions, whereas waiting for the right opportunity can yield substantial rewards. This patient approach ensures that investors are not misled by short-term market movements, but instead recognize and utilize the long-term potential of an investment. Ackman also draws a clear distinction between speculation and investing. Speculation aims to take advantage of short-term price movements and is highly influenced by emotions and market sentiment. It involves significant risk, as speculators often do not have a deep understanding of the asset they are trading. Cryptocurrencies, for instance, are a typical example of speculative investments for Ackman. Their high price fluctuations attract many investors looking for quick gains, but these investors often lack a deep understanding of the underlying technology or potential long-term value. Ackman, on the other hand, focuses on determining a company's long-term value through thorough analysis of its cash flows, earning power, competitive advantages, and market position. By concentrating on these fundamental aspects, he can better estimate the intrinsic value of a company and identify opportunities where the market has mispriced a stock. This shift in focus from short-term price movements to a long-term perspective allows him to make informed and sustainable decisions based on real economic fundamentals, rather than being swayed by the whims of market sentiment. Long-term investments and examples. An outstanding example of a promising long-term investment is the Universal Music Group, UMG. Ackman sees UMG as a stable investment because music is an unchanging part of human culture. Although the way music is consumed has changed significantly over the decades, from records to CDs to streaming, the demand for music remains constant. UMG benefits from a vast music library that includes works by artists like the Beatles and the Rolling Stones, as well as current popular artists. The company's ownership of such a diverse and extensive catalog gives it multiple revenue streams, including royalties from streaming platforms, licensing deals, and traditional sales. This unique position in the music industry provides UMG with a level of stability that few other companies can match. Moreover, Ackman believes that the business model of UMG is highly adaptable to changing consumer preferences. The transition from physical sales, records and CDs, to digital streaming was initially disruptive for the music industry, but UMG successfully adapted by partnering with streaming services like Spotify and Apple Music. These partnerships have helped the company maintain its strong market position while capitalizing on the increasing popularity of music streaming. Ackman sees the music industry's transition as a prime example of how long-term investments in adaptable businesses can continue to generate strong returns, despite major shifts in consumer behavior. Another example of Ackman's long-term approach is his investment in the restaurant chain Chipotle. When Chipotle's stock price fell sharply due to food safety issues, Ackman saw an opportunity. For him, it was a temporary problem that could be solved with the right management. He conducted a thorough analysis of the company's underlying business model, customer loyalty, and brand value. Ackman believes that many fast food chains experience food safety issues at some point, but most overcome these difficulties if the core product and customer experience remains strong. In the case of Chipotle, Ackman recognized that the brand had a loyal customer base and a commitment to quality that would enable it to recover. Ackman's decision to invest in Chipotle when market sentiment was negative was based on his confidence in the company's ability to address its operational issues and regain customer trust. His long-term perspective allowed him to see beyond the immediate challenges and recognize the company's potential for growth. This example highlights Ackman's ability to identify value in situations where others see only risk, which is a key component of his overall investment philosophy. Trust in management and financial security. Another important aspect of Ackman's philosophy is trust in a company's management. Ackman only invests in companies whose leadership he deems capable, trustworthy, and aligned with shareholder interests. He believes that good management is crucial for the long-term success of a business. To assess the quality of a company's leadership, Ackman analyzes annual reports, monitors earnings calls, and looks at the historical track record of the executives. He wants to ensure that management is not only competent, but also honest and transparent in their communications with shareholders. Leaders who overpromise and underdeliver are considered high risk by Ackman. For him, it is crucial that the company's leadership thinks long-term and makes sound, well-considered decisions. He particularly values management teams that have a consistent vision for the future and demonstrate their ability to adapt to changing circumstances without compromising the core values of the business. Ackman prefers investing in companies where management owns a significant stake, as this alignment of interests ensures that executives are motivated to act in the best interests of all shareholders. Another example of Ackman's foresight is his view on technological disruptions. Technologies such as artificial intelligence have the potential to change or even destroy traditional business models. Ackman cites Alphabet, the parent company of Google, as an example. Alphabet has the potential to lead in the field of artificial intelligence, thanks to its substantial investments in AI research and development, as well as its control over vast amounts of data. However, the competition is intense, particularly from rivals like Microsoft, which is collaborating with OpenAI. Ackman believes, however, that Google is well-positioned to compete in this area due to its strong financial position, established infrastructure, and deep expertise in machine learning. Ackman's philosophy also emphasizes the importance of financial security for investors. He warns against investing money that one cannot afford to lose. This principle is grounded in the idea that financial stability allows investors to remain calm during market downturns. Those who are financially stable can make rational decisions rather than panicking and realizing losses. Moreover, Ackman avoids taking on debt to finance investments, as leverage can force investors into making hasty decisions when markets are volatile. By maintaining a conservative approach to debt, Ackman ensures that he has the flexibility to hold on to his investments during difficult times and wait for them to appreciate in value. A central point of Ackman's strategy is focusing on a few well-understood companies. He believes that too much diversification can be inefficient, as it prevents the investor from gaining a deep understanding of each individual company. Ackman prefers to invest in a small number of companies whose long-term potential he truly understands and believes in. This concentrated investment strategy allows him to devote more time and resources to researching each company thoroughly, which in turn increases his confidence in the investments he makes. Examples of such companies are Chipotle, Universal Music Group, and Alphabet. In summary, Ackman's approach emphasizes long-term investing in stable, well-managed companies. Emotional stability, thorough analysis, and patience are the keys to his success. He is convinced that investing in companies that benefit from stable, long-term trends and are well-managed is the best way to achieve sustainable financial success. His years of experience and successful track record confirm that this approach works.